Welcome to Investment Management Certificate, Edition 8. Unit 1. The Investment Environment, Investment Management and Advice in the UK Context. Topic 1. The UK Financial Services Industry, a European and Global Context. In this chapter, we provide an overview of the financial services sector and examine the impact of the international environment, particularly Europe. On this sector, we introduce the role of the financial services sector and briefly outline the role of government in the economy. This is followed by a discussion of European moves to harmonize financial services. The method of implementation of EU directives is then outlined, before two of the main directives affecting the investment sector are considered in some detail, namely the Markets in Financial Instruments Directive, MIFID, and the Directive on Undertakings for Collective Investment in Transferable Securities, UCITS. The government announced in June 2010 that it intended to reform the institutional framework for financial regulation. A new Consumer Protection and Markets Authority will take on the FSA's responsibility for consumer protection and conduct regulation. Regulation of banks will pass back to the Bank of England, with macroprudential regulation of banks overseen by the Bank of England, and a newly created subsidiary of the Bank of England, the Prudential Regulation Authority, conducted microprudential regulation of banks and insurers. Let us begin by looking at Chapter 1, Section 1. The financial services industry and the role of the government. The financial services sector provides four core functions in an economy. Financial intermediation, which is a financial system provides the mechanisms for the channeling funds from savers to those who need to borrow funds. Financial intermediaries significantly reduce information and transaction costs in the economy, providing suitable services and products for savers to become investors, ensuring the adequate provision of information, and by minimizing the cost for borrowers in relation to the number of savers that would otherwise have to be approached and to the variety of terms that they would demand. Figure 1.1 below illustrates some of the main flows that can take place in the financial system. Savers can supply funds directly by holding the debt and equity securities issued by borrowers, or they can supply funds to an intermediary such as banks or investment institution. While there can be circumstances in which direct financing through capital markets is appropriate, most forms of capital raising and saving involve financial intermediaries. Banks and other accredited institutions such as building societies have traditionally been a key source of finance for individuals, companies, other borrowers, and a vehicle through which individuals can save. They perform an intermediation function themselves. Increasingly, the banking sector interacts with the securities markets to raise capital. Rather than relying on retail deposits or to invest in those markets, securities have grown much faster than bank deposits as a share of total financial assets in recent years. Insurance companies, pension funds, and other investment institutions or vehicles such as OEICs, unit trusts, and investment trusts also perform an intermediation function by collecting funds from savers and investing those funds in securities issued by borrowers, equities, and bonds. Investment companies such as insurance companies also purchase the securitized assets of banks. 2. Another way is pooling and managing risk. There's another way that financial and services sector provides the core functions in an economy, which is by pooling and managing risk. The financial services sector provides mechanisms that allow the efficient management of risk. This could be through pooled investment funds, insurance, or derivative products. Pooled investment funds such as unit trusts, open-ended investment companies, OEICs, and investment trusts allow savers to pool their funds with other savers and so invest in a wide variety of investments, therefore reducing an individual's overall risk exposure. Similarly, corporate pension funds pool the contributions of participants. Insurance allows individuals and companies with a risk exposure to transfer this to the insurance company in return for payment of a fee. This transfer responsibility for selecting borrowers to an institution allows pooling and more efficient management to take place. Derivatives such as options, futures also allows investors and borrowers to manage their risk exposures. Payment and settlement services. The financial system provides the mechanisms for money and other financial assets to be managed, transmitted, and received. And number 4, portfolio management. The financial system allows investors to manage their wealth through access to financial markets, specialist advice, and investment management services. So the 4 methods is financial intermediation, pooling and managing risk, payments and settlement services, and portfolio management. Let us now look at the institutions. There are a wide range of financial intermediaries linking savers and borrowers. Here we briefly review the main institutions in an advanced financial system. The central bank is a key financial institution that is involved in setting the monetary framework within which both the economy and financial institutions operate. Financial intermediation involves the transfer of funds between surpluses and deficit agents. We distinguish here between deposit-accepting institutions such as banks and savings institutions, and investment institutions such as insurance companies, mutual funds, and pension funds. Deposit institutions accept deposits from economic agents which become liabilities of these institutions, and then lend on to these funds as direct loans or investments. These include commercial banks and building societies. However, the banking sector contains a wide range of different types of banks, including universal banks which offer financial services as well as traditional deposit and lending facilities, and investment banks which act as brokers, underwriters, and mergers advisors. Like banks, savings institutions accept deposits and make loans, although they usually operate under different rules to banks. Investment institutions are also intermediaries, but unlike banks, they invest the funds they raise in tradable securities, such as bonds and equities. Insurance companies act to offer protection against the occurrence of fortunate events in exchange for a premium. Life insurance deals with deaths, illness, and retirement policies, whereas general insurance involves theft, property, house, car, etc. The different nature of life and general insurance is reflected in their different investment strategies. Life insurance funds tend to hold longer-term assets, reflecting the longer-term nature of their liabilities. General insurance companies will tend to hold short-term assets, reflecting their more immediate need for cash. Mutual funds or unit trusts and investment trusts are also important collective saving vehicles. Pension funds are now significant institutional investors in many countries, especially with falling state pension and an aging population. Next, we look at the role of the government. Broadly speaking, governments essentially perform 4 functions. First is the production of services which private firms are either unwilling to produce. Number 2 is regulation of firms. Number 3, intervene in the distribution of income. And number 4, stabilization of the income. First, the production of services which private firms are either willing to produce or for some reason are not allowed to produce, or at least not exclusively. This is often referred to as a market failure. This public provision includes defense, law and order, and investment in roads. Industrial policy may involve grants and subsidies to promote certain sectors considered worthy of support, and for which the market may not provide a satisfactory solution. Example, green activities, or for which the market does not publish or punish externalities such as pollution, and hence carbon taxes, tobacco taxes, etc. Of course, government regulations may also include banning dangerous chemicals, promoting food and hygiene standards, ensuring drug safety standards, maintaining road and air safety, etc. The second function is the regulation of firms, principally to protect the consumer. This includes regulation to promote competition, to prevent fraud, etc. Governments also attempt to regulate markets through restrictions on entry into the market and rules governing behavior in markets. In the UK, the Financial Services Authority, the FSA, plays the main role in regulating financial markets. This is covered in more in later chapters. The third function is to intervene in the distribution of income generated by private market transactions in order to conform to some criterion for equity. For example, a minimum wage guarantee. Redistribution of income and wealth is also a policy of most governments, and this will often be achieved through transfer payments to households, for example state pension payments and other welfare payments. Taxation is also used to achieve a better distribution of income among the population. The fourth function is the stabilization of economy by accepting to reduce fluctuations in income and employment and to control movements in the general price level. In many economies today, emphasis is placed on controlling inflation by using interest rates. In the UK, this is carried out by the Bank of England. The role of this institution is covered in more detail in later chapters. In 2008-09, we also saw many governments intervene to stabilize the financial system through capital support for distressed financial institutions.